Your bank already knows your balance. And from that single number, it has quietly decided what kind of person you get to be, the fees you pay, the rates you receive, and whether anyone bothers to come out and greet you. You think you opened a checking account. What you actually received was a class assignment. And once you see how the system works, you won't be able to stop seeing it everywhere. Today we're following Alex. Alex has $800 in checking, roughly where the bottom quarter of US households actually lives. By the end of this video, you'll understand exactly why Alex is quietly funding a lifestyle he's never seen. Here's the rule nobody announces: the wealthier you are, the less it costs to borrow. The poorer you are, the more it costs just to exist. Same bank. Same logo. Completely inverted math. Alex walks into his bank. On paper, his account is free until he misses a direct deposit window and gets hit with a $15 monthly fee. Then his car insurance autodrafts on a Tuesday when his paycheck doesn't clear until Wednesday. That's a $35 overdraft. His phone bill hits the same day. That's $70 more. In 8 days, Alex paid the bank $120 for the privilege of being slightly short on rent. The CFPB has tracked this for years. Roughly 9% of bank accounts pay about 79% of all overdraft and NSF fees in the country. Those accounts tend to carry average balances under $350. The average person paying overdraft fees loses about $260 a year. Over 10 years, that's $2,600. Alex could have had a decent used car. 2 months of emergency rent. The beginning of a down payment on a home he's not going to buy. The bank didn't just take his money, it took his runway. And they know it. The CFPB proposed capping overdraft fees at $5 in 2024. Congress repealed that rule in spring 2025. The very next quarter, USAA's overdraft revenue jumped 20%. Citizens Bank jumped 17%. JP Morgan and Bank of America went up too. The banks lobbied for the right to charge Alex $35 when he's already short. And they won by a vote. Alex is also more likely to be denied a standard credit card. So he ends up with something like the Indigo MasterCard, a $175 annual fee, a $700 credit limit, and 35.9% APR. That isn't a credit card. That's a subscription to credit. Alex is paying for the right to be allowed to borrow money. And when Alex tries to dispute any of these fees, he calls customer service. He waits 15 to 45 minutes. He hears soft jazz and a recording telling him his call matters 6 times. Eventually someone reads from a script that doesn't include a button for refunds. Meanwhile, Brad is still in the back office. Brad has not come out for Alex. Alex doesn't know Brad exists. Now say Alex works harder and builds up $20,000 across his accounts. At Bank of America, that gets him gold tier, 25% bonus on credit card rewards, some fees waived. At Chase, $15,000 across the relationship waives monthly fees entirely. What just happened? Alex was paying the bank. Now he's allowed to break even. That's the promotion. Push it to $50,000 and Alex hits platinum, 50% rewards bonuses, an ATM fee waived once a cycle, a quarter point off auto loans, $400 off mortgage origination. The bank is starting to be slightly nice. Not because they like Alex. Because Alex is now a useful customer, and they're willing to share a fraction of the profit to keep him there. At $100,000, Alex becomes platinum honors. Unlimited domestic ATM waivers. 0.5% off auto loans. $600 off mortgage origination. At Citi, $200,000 puts Alex into Citi Gold territory, a wealth advisor assigned to him, free wires, no foreign exchange fees, and access to physical Citi Gold lounges in New York, London, and Hong Kong. Banking lounges. Like airport lounges, but the entry requirement is a balance, not a boarding pass. This is where the bank begins performing relationship. The wealth advisor isn't really an advisor. He's a salesperson with a softer title. His job is to keep Alex's money inside the bank's ecosystem, the bank's investment products, the bank's mortgage, the bank's insurance. all of which tend to carry higher fees than what Alex would find if he shopped around. But it feels personal. And personal feels like value. Even when the math says Alex is paying for the privilege of being known by name. At $150,000 across deposits and investments, Alex becomes a Chase private client. This is the line where the rules don't just bend, they flip. Alex now has a dedicated banker. An actual human being whose personal phone number he has. Brad calls Alex. Brad does not put Alex on hold. If Alex has a problem at 11 at night, Brad answers his cell. Alex also gets a dedicated JP Morgan private client advisor for his investments. Overdraft fees gone. Wire fees gone. ATM fees worldwide gone. Foreign exchange fees gone. Brad now knows Alex's kids' names. Brad sends a birthday card. Brad has reportedly hand-delivered a replacement debit card to a client's house before a vacation. That is not an exaggeration. That actually happens at this tier. Alex has moved from a customer the bank tolerates to a customer the bank genuinely loses sleep over losing. That shift in how the institution thinks about him is what every single perk in this tier is really paying for. If Alex reaches $1 million across the relationship, Chase gives him a quarter point off his mortgage rate. A quarter point. Doesn't sound like much. On a $600,000 mortgage over 30 years, that's roughly $30,000 in interest Alex never pays simply because the money was sitting at the bank. Bank of America does the same. At their Diamond Honors tier, which starts at $1 million after they merge tiers in May 2025, Alex gets 0.3% off his mortgage rate, 0.75% off HELOC rates, and 0.5% off auto loans. He also starts receiving curated experiences with partners like Louis Vuitton and NetJets. Bank of America genuinely partners with NetJets to offer wealthy clients private jet access. That is a real product that exists right now. Now stop and look at the math from the other direction. Remember Alex at $800 paying $35 for an overdraft? That money is, in a very literal sense, funding the perks Alex at $1 million receives. The bank takes overdraft revenue from the bottom and redistributes a portion of it as Louis Vuitton experiences for the top. That's not a metaphor. That's how the income statement of a major bank actually works. The fees collected from people who can't afford them subsidize the rewards given to people who don't need them. The first version of Alex paid for the seventh version of Alex's private jet weekend. And the cruelest part? Nobody in the chain feels like they're doing anything wrong. Brad is genuinely a nice guy who remembers your kids' birthdays. The CEO is optimizing for shareholders. The customer service rep couldn't refund Alex's overdraft, she was also reading from a script. The whole machine produces a clearly regressive outcome through a series of decisions made by people who would each describe themselves as just doing their jobs. There is no villain. There's only a sorting algorithm wearing a polite face, which is somehow harder to be angry at than an actual villain. You can't write a strongly worded letter to a pricing tier. Push past $3 million and Alex enters Bank of America's private bank, formerly known as U.S. Trust. He stops being a customer and becomes what the bank calls a relationship. Alex now has a team, a private banker for daily needs, a wealth strategist for portfolios, trust officers for estate planning, and a specialty lending banker who structures jumbo mortgages with minimal documentation. Art loans against collectibles. Aircraft financing. Bank of America Private Bank even manages farmland and timberland on behalf of clients, though they'll tell you plainly that the minimum for that service is $10 million, with a net worth of $100 million required just to buy in. There are bank products with a $100 million net worth requirement. That is not a typo. At JP Morgan, Alex with that kind of money becomes a JP Morgan Private Bank client, a different brand from JP Morgan Wealth Management, which is different from JP Morgan Private Client. 3 brands. All called private something. All meaning different things. JP Morgan recently raised its private bank minimum to $10 million after an internal review showed 90% of clients already cleared that bar. They are openly narrowing their own client list. Here's where the system stops being about perks and starts being about power. At this tier, Alex stops borrowing money the way regular people borrow money. He pledges his stock portfolio and receives what's called a securities-backed line of credit. Schwab will lend against his portfolio at roughly 5.5 to 7% in early 2026 numbers. Fidelity, Morgan Stanley, same structure. Now go back to the beginning and put the numbers side by side. Original Alex pays 35.9% APR on his Indigo MasterCard. Wealthy Alex borrows from the same banking system at 6.5%. That's a 29-point gap. Same logos. Same regulators. Inverted math. And the punchline, wealthy Alex doesn't repay the loan from income, because pulling income from his business would trigger 37% federal tax. He keeps borrowing against his stock. The stock keeps rising. When he dies, his heirs inherit it at a stepped-up basis, wiping out the capital gains tax entirely. The loan gets paid off from the estate. This strategy has a name: buy, borrow, die. ProPublica ran the numbers using leaked IRS files. The 25 wealthiest Americans saw their net worth grow by $401 billion between 2014 and 2018. They paid $13.6 billion in federal income tax, a true tax rate of 3.4%. Jeff Bezos's true tax rate was 0.98%. For every $100 his wealth grew, he paid about $1 in tax. The typical American paid $160 in tax for the same $100 of wealth growth. The bank made this entire arrangement possible by being willing to lend against stock instead of requiring a sale. Alex's overdraft fees paid for the marble lobby where the meeting happened. So what is a bank, really? It's not your friend. It's not your enemy. It's a sorting algorithm with a marble lobby. It looks at your balance, prices you accordingly, and then wraps that pricing in language about service, relationship, and rewards. The fees aren't a bug, they're a tier. The rates aren't market set, they're relationship set. The hold on your check isn't a security policy. It's a discount applied to your time. Once you see this, small things stop being mysterious. Why your call goes to hold but your wealthy uncle's banker calls him back. Why your credit application requires a hard pull while someone with money gets pre-approved on a soft one. Why the same institution charges 36% on one floor and 6% on the next. None of it is personal. All of it is calculated. The marble lobby looks the same to everyone, but the price of that marble depends on which door you walked in through. The most useful thing you can do with this information is simple. Stop feeling grateful when the bank doesn't punish you. Stop reading "no monthly fee with qualifying balance" as generosity, it's the bank telling you in writing the exact price of not being charged. Stop assuming Brad doesn't exist. Brad exists. He's just not for you yet. Alex will walk into his bank tomorrow. He'll deposit a check that won't clear until Monday. He'll pay a fee he didn't read about. He'll listen to soft jazz for 23 minutes. Somewhere on the other side of the building, Brad is escorting someone into a private office. Brad doesn't know Alex's name. Alex is paying Brad's salary. Alex is paying for the office. Alex is paying for the marble. Nobody at the bank is going to tell him that, and that part is on us.